available on the platform. And we're excited today to have Dave here with us from Baker Tilly. And a little bit about Dave. So he has been an integral part of Baker Tilly Corporate Advisory Services Group since 1999. His years of experience working with owner-managed private companies has given Dave a unique understanding of business value and strategy. His client services focus includes business valuations, mergers and acquisitions, transaction support, succession planning, capital structuring, and general business consulting. Dave employs his specialized industry knowledge in agribusiness, oil field services, transportation, and professional service firm to maximize benefits for the businesses that he works with. Welcome, Dave, and thanks so much for being here with you to explain more about Baker Tilly and take it away.
Great, thank you, Liz. So Baker Tilly, yeah, quite a few on the call might wonder what that's about, because for a lot of years I've been with a firm called Catalyst, and I see Robin's on the call, and Robin and I worked together years ago, and so Baker Tilly is fairly new for us. We actually just joined the network 2 weeks ago. So it still seems a little weird when I get announced working for Baker Tilly. So for us, it's a new name and we're poised for growth, but we continue to be the same partnership group, the same staff, working with the same clients and doing the same work. So for those of you that might not know, Baker Tilly was rebranded from the old legacy firm Collins Barrow several years ago now. And so Baker Tilly, we have 50 offices, over 20 firms across Canada, all flying the Baker Tilly banner. And then we also do have a fairly strong international presence as well. And for those that might care, Baker Tilly is currently Canada's 8th largest CPA firm by revenue. But like I say, our core services here at Baker Tilly Catalyst haven't changed. We're a full service accounting firm, tax advisory, corporate finance, where I work, wealth, CFO, and joint venture auditing, 9 partners, about 60 staff, depending on the day, most of them working virtually these days, but we do still check in quite frequently, and working with the mid-market and small business community within Southern Alberta. So I'm going to talk today about the valuation of small business and ultimately, does buying a small business make sense? And I look at several of the attendees here today, and some of you might be more adept at giving this talk than I'm going to be, but hopefully as I go through it and get to the end, we can have a good interactive session and get some stimulating conversation going. So I always say yes, it often does make sense to buy a small business. You know, you can buy a track record, you can have access to immediate cash flow, and potentially access to financing through the old owner, which could happen through the transaction process. But could be lots of things to keep in mind, and including the cost benefit. It always depends on what the asking price or the negotiated price of the business is, and whether or not it makes sense for you to buy that business or to start a greenfield business. Ultimately, with a small business, quite often you are buying a job, and you need to keep that in mind, and we'll talk to that a little bit as we get into the session. And the one that I think quite often gets overlooked is the owner mentality is required of the purchaser. And, you know, quite often the buyer doesn't, if they haven't been exposed to being an owner in the past, they might not be prepared for what they're getting into, and they may not have the skills, the desire, or the risk tolerance. So all of those things have to be considered. You know, for today's purposes, what is a small business? I don't think there is an exact definition that I've seen, but for today, let's say it's annual revenue of less than 2 million. Quite often it can be quite a bit less than that, and it could be in the $500,000 range. You know, staff usually under 10, and again, quite often considerably under 10. Just about always owner operated, and can be structured as a proprietorship or a corporation. But you know, there's lots more differences between a small business and the mid-market than just the financial side, the dollars and cents. And you know, to me, you gotta, other distinguishing factors can be, you know, as far as ownership, it's generally all inside owners, people working in the business within small business, versus with a mid-size, there could be some outside owners. You know, the type of buyer, again, for a small business is usually always going to be the active manager, the employee, or a competitor. Whereas for a mid-sized business, the buyer group could include some financial buyers, some investors that are looking to be kind of hands-off. So you might see that in a mid-sized business. And you know, as far as the buyer motivation for a small business, you know, quite often it's looking to get a good paying job. So then it becomes more of a return on labor, rather than in the mid-sized business, where yes, there could be a return on labor component, but wealth creation and a return on investment are maybe equally or more important to the buyer group there. And I'm not going to hit on every point here, guys. I believe the deck will be housed within the Village Wealth portal. So if anyone wants to circle back and look at these, but we want to get into the Q&A of as quick as we can here. So, you know, the compensation side is pretty important here. And, you know, ultimately the owners look to pay themselves whatever the business can afford. And whereas, you know, on the mid-size business, the employees get paid a fair wage for their services, and then the owners receive some form of distribution, non-wage distribution, usually in the form of a dividend, which may or may not happen in the small business depending on size. You know, the wealth diversification can be an important one, because for a small business, quite often for the owner, the business itself is their primary you know, piece of wealth that they have within their portfolio. And you know, the small business is ultimately going to lead to their retirement plan. Whereas for the owners of a mid-sized business, quite often they have other investments and they have a more diversified personal portfolio. The capital cost with a small business can't be overstated, that there's generally a higher cost of debt and a higher cost of equity as compared to the mid-sized business. And then just I'll wrap up with the financial data quality is always a big issue. You know, in a small business, usually it's a notice to reader set of financials, may or may not be GAAP or ASPE compliant. And the owner may not even provide or work on monthly financials. Whereas in the mid-size, it's generally an audit or a review. GAAP is met and complied with. Monthly financials could be even sophisticated budgeting and projections involved. So you can see the lots of differences between a small and a mid-sized business, other than just the dollars and the cents. But you know, ultimately, it's when you get to the core of evaluation, it's the same drivers that between whether you're talking about a small business or you know, a very large business. You know, we're talking about future cash flows, the growth of those cash flows, and the risk in achieving those cash flows, which gives you essentially for those of you that might remember your college finance, the Gordon growth model. And really that still regardless of the size of the business, that is the crux of the valuation process. You know, you have some form of a ongoing, repeatable cash flow, you have a multiple, you take the two together, and that is going to suggest or at least indicate some form of value. But you know, that's the concept, and that's the you know, the financial theory, which is all great and needs to be looked at. But you know, a small business is different, and because you know, with the owner operator, sometimes you know, they are buying a job, and ultimately that needs to be kept in mind. And when you have that mentality or that in place, then you're talking more about a return on labor rather than a return on investment. And sometimes owner operators, they do make less than if they were an employee working in the same industry for someone else. But research does show that they tend to be happier. And, you know, but that intangible happiness and benefits that they feel of owning a business, it's difficult to quantify, and quite often doesn't get incorporated into the overall valuation of the business. As I mentioned before, you know, quite often people looking to buy a small business may have little or no, you know, ownership experience. They may not even have experience in that industry. And that all needs to get factored into their personal valuation exercise, which ultimately leads to price. And I'll close off this slide by talking about seller's discretionary earnings, which is an acronym SDE. And I always find it's an important metric for small business. And really, you know, SDE, or seller's discretionary earnings, really what it is, it's your normalized EBITDA, but you add back the compensation for the primary owner operator. So it's a bigger number than EBITDA, but it now includes that cash flow measurement, which has been normalized, and we'll call that EBITDA. But then we're also adding back the compensation for the owner operator. And ultimately, then that number, or that SDE total, allows for a return on labor for the purchaser, and also, you know, funds hopefully to service debt, to maybe pay a little bit of tax if required, and also to invest for future capital investments as well. And, you know, compare that to free cash flow, which is quite often what you focus on when you're valuing let's say a mid-market business. And, you know, free cash flow is really the dividend paying capacity of the business, which ultimately provides for that return on investment. I mentioned normalized EBITDA on the last slide, and that's always an important component when you're valuing a private business, but probably more so when you're valuing a small business. And really what you're trying to do here is separate business related expenses with more discretionary or owner related expenses. So you're normalizing or cleansing, if you will, the historic results. You want to consider compensation paid to the owners and make sure try to adjust it to a market rate, and that's for EBITDA. If you're talking about SDE, then you're essentially adding back the compensation that has been paid to the primary owner. The perks and personal expenses that may flow through the small business P&L, you want to identify those and try to adjust for them if you can. Some small businesses, you know, potentially a restaurant, for example, let's say, where there may be some cash cash business component of it that may or may not be reflected in the P&L. You want to try to at least consider that. You may not want to pay for it if you're looking to buy this business, but it's good to understand if it's there and what the quantum of it might be. But of course, all of this gets back to the quality of records comment we made earlier. And with a small business, quite often the quality of records can be a little bit haphazard or suspect, and that's not slagging a small business owner, but it's just reality that the records may not be GAAP compliant, and they may be not quite as robust as for a larger business. As far as what valuation methods are generally used for small businesses, what I generally see and work with business owners on are market multiple approaches, and whether it's EBITDA or seller's discretionary earnings, or even potentially a revenue multiple. Sometimes you try to triangulate using 1, 2, or 3 of those methods. You can also look at the free cash flow approach and a capitalization of same. I mentioned that may or may not be as applicable for a small business. The net asset value approach, looking at the hard assets and considering what the current market values of those assets are as compared to a depreciated book value, that's usually going on in the background. A discounted cash flow approach is rarely used for a small business, I would suggest, whereas you quite frequently would get pointed in that direction for a larger business, and rarely used because small business owners usually don't budget or project many years into the future. And if there is, maybe there's the reliability of those numbers is maybe somewhat suspect for us. So a DCF approach, very rarely used. I just pulled together kind of based somewhat on a file that I worked on a few years ago. It's an auto body repair shop, and but the names and the numbers have been scrubbed to protect the innocent. But I've looked at 3 different approaches here. The seller's discretionary earnings approach on the left, a revenue multiple approach in the middle, and then an EBITDA multiple approach on the far right. So you start off with, let's call it what you project to be a maintainable amount of revenue going forward. In this case, $1.5 million. The financial statements were suggesting EBITDA was about $100,000. We found $50,000 of personal type expenses, which we normalized for. Those were primarily personal vehicle related numbers as far as maintenance and insurance, that type of thing, and a few other odds and ends. You come up with your normalized EBITDA. And then in the seller's discretionary earnings approach, we add back the $125,000 that the old owner paid himself to get to a $275,000 SDE. We put a multiple on that. In the revenue side, it's a much higher level concept towards valuation, and it depends on the industry. Sometimes revenue multiples can be fairly accurate. Sometimes they're just really a really high level ballpark estimation. And in the EBITDA multiple approach, we looked at that as well. And you know what? They came in within, call it between $450,000 and almost $500,000 of value. What did that value include? Because in this process, the old owner was looking to sell. So there was about $300,000 of market value capital items, so furniture, fixtures, and equipment. And then in this case, in this industry, we suggest that the inventory would be acquired over and above the business purchase price. Every industry can be a bit different on that aspect, and then it always comes down to the negotiation as well. So you can see, looking at these three approaches, the value came in, within a fairly tight range. And the client did go to market, as I understand it, and actually accepted a price that was somewhere in that range. So in that case, I think we were fairly tight as far as what the estimated value was. As far as where the multiples come from, that's always a bit of a black box, if you will, for a valuator. And definitely there's a fair bit of experience that goes into that, as far as potentially research that the client can do, as far as looking on the web, as far as trying to find rules of thumb, potentially talking to other brokers or bankers, that type of thing. So, but quite often, if you are preparing for a sale, you may talk to a valuator as far as what multiples might be in your industry. But that's all nice. That was kind of a front end valuation, which is still a bit notional, fair market value exercise almost. But if you are going to market, the objective is always to establish the price, and fair market value and price may be the same, they may be similar, they may be totally or quite widely divergent. They are unlikely to be the same number. And, typically it's going to start, everyone on this call knows it, as far as what the negotiation process is. And hopefully you're able to get into that, what I call the bargaining zone, where each party is, looking for an acceptable, accepted price or a purchase price. And then the bargaining comes down to landing on the ultimate purchase price. As far as the transaction itself, we can talk further about whether the sale is going to be a share or an asset deal. And I see both for small businesses, probably an asset structured deal are a little bit more frequent than a share deal, but, definitely see both. And it comes down to the agreement that you make with the potential buyer. Usually the capital assets, the furniture, fixtures, and equipment are included in there in the deal. And then if in fact there is any intangible value or goodwill that might be included. As I mentioned before, inventory sometimes is in the price. More often than not, it's a additional component to the value. But again, it does depend on the industry that you're in and what you agree to. Usually most small business deals are free and clear of all liabilities, and generally no other working capital would be included in the transaction. As far as if there's a head office lease or location lease, any licenses, software, or that type of thing, or contracts potentially with a customer or a client, those are usually negotiated and assigned as well. As far as whether or not the purchase might be willing to carry some of the purchase price, that's a negotiated item. But generally, some type of a non-compete agreement is included in the price, and that's a non-compete with the old owner. And the seller, every deal is different, but usually there is some type of a requirement that the seller provides some level of training or transition assistance for the new owner. I'll maybe just wrap up, as far as mistakes to avoid for the purchaser looking to buy a small business, you know, I would be loath if I didn't start off with you should retain some level of external support, professional advice, whether it's your accountant, your lawyer, a broker, whatever the case may be, but someone to provide assistance with the transaction. You know, I always say that ignoring the history or the culture of the particular small business you're looking at comes with peril, because it's very important and you need to consider that in your due diligence. But at the same time, you need to not get so caught up in the transaction and the negotiations that you don't plan for what comes next and what happens once you own the business. So that needs to be going on as you're doing your due diligence, if not before. Paying too much, it doesn't matter if you're a small business or you know, an international business. Paying too much, it's hard to come back from that. It's tough to get a significant or a material return on investment, at least for the first number of years, if you have paid too much. And I always say, you know, burning bridges with the old owners is a mistake. Sure, you're going to have a spirited negotiation on price and other terms, but I'm always a fan of keeping that fairly as civil as you can, and then moving on and, you know, maintaining a good relationship with the old owners, because you never know when you're going to have to call on them for advice or to get their input on the business that you now own. With that, Liz, that's the formal part of my presentation, so I'll maybe turn it back to you.
Thanks, Dave. Well, we do have some questions here, and this is kind of the fun part when we get some more candid conversation going. So don't be shy if there's anything or anything that you've come up with. I know there's a lot of advisors here today. If there's anything that's come up as a question in your practice that you know you want to field to Dave, feel free to throw it out there. But I'll just start with what questions we've got already. So Dave, you know, you've been fairly clear that, you know, some of the valuation tactics are different between small business and larger businesses. Can you go into that a little bit more? Like why do you see that there's some big differences here when you kind of cross that threshold into mid-market?
Yeah, and you know, as far as the question, quite often, if I can rephrase it, Liz, is there are small businesses valued differently than big business? And I kind of answer that like any good advisor, yes and no. There is a difference. On the no side, I always go back to the Gordon growth model. And so, you know, a valuation of any business or asset is essentially the cash flow it can generate multiplied by some type of a multiple. And so that's the same whether you're a small business or a much larger business. But, you know, on the yes, they are different side of the equation, you know, a small business can provide a long-lasting good living for a family and a legacy and funds for retirement. But, you know, it may not provide a large return on investment for the business owner. And, you know, so quite often that's why the seller's discretionary earnings concept can be focused on for a small business, because you do need to incorporate as much as you can a return on labor factor which ultimately drives the valuation of a small business, or I believe it does anyway. You know, also there's less information generally available for a small business. And quite often it's a smaller pool of potential buyers. So, you know, all of that factors into the ultimate price and the negotiations that might go on. And again, I can't overemphasize that, you know, getting ready to sell a small business isn't really a fair market value exercise. Sure, that can be a starting point, but as an owner looking to sell his business, it's kind of a fair market value as a starting point, and then you need to be prepared for the negotiations that are going to go on, which ultimately will direct you to price. So hopefully I kind of answered that, or at least touched on it.
Yeah, thank you. Chuck, I see you popped in there. Do you have a question?
I do, Liz. Thanks. And David, thank you for the presentation. Couple of quick questions. From your side, when a seller comes to you and says, we need your help, we're thinking of selling, etc., what do you recommend as the financial package? Is it 1 year, 2 years, 3 years of P&Ls, balance sheets? Like, what do you recommend the seller should have at the ready so that when they list it, they're ready to slide across the table?
Yeah, thanks, Chuck. I usually say 3 years. And of course, every business is going to be different, and especially now that we have at least 1 year of COVID results in the business, that needs to be considered. But as a starting point, I generally say 3 years. If it's supportive for the business owner, I would even go back to 5 years, if you're trying to show consistency or consistent growth. If you can demonstrate that over 5 years, I think there's additional value there than just keeping it to a couple of years.
Okay, thanks for that. Second question is new election, obviously, similar result. But one of the things that I was particularly watching for during the campaign was the Liberal platform on capital gains. So when you go to sell your business, they were talking about clawing that back to some degree. Have you heard anything? Like, what are the winds of change that you're hearing on the horizon for capital gains?
Yeah, it kind of old talking head song, same as it ever was, right? As far as the results of the election. And, haven't heard any definitive or what I would call substantiated rumors as far as changes to the capital gain exemption rules. Of course, every year at budget time, there's always, and especially the last few years, concern that there was going to be a change. And, for the last couple of years, we've continued to skate through that without any changes, which is great as we work with our small and mid-sized business owners. But, I just can't, and this is just my own personal opinion, but with all the money that's been pumped into the system and borrowed to pump into the system for COVID, I just can't see tax rates going down much for the immediate future. And as governments look for new sources of revenue, I just can't help but think that exemption rate is, could be picked away at in the coming years. So nothing definitive, Chuck, but it's definitely something we at Baker Tilly are trying to keep an eye on.
Yeah, great. Last comment I would make, and it's more of a general comment, and it's a bit of a plug, I guess, in a way. I have been an entrepreneur all my life, sold previous business, ran it for 21 years, etc. And I engaged a service much like yours, David, and my accounting firm, tax law, that, they were quite far reaching in all aspects that way. And what I could say to everybody is it was the best. It was the best money I have ever spent in order to get my business ready for sale and then getting top dollar for it. So definitely recommend engaging with somebody like you, Baker Tilly, in order to get top dollar for the sale of their business.
Thank you. Music to my ears, but yeah, it can be difficult at times, Chuck, as you can well imagine, as a business owner, to try to substantiate, especially at the front end of a transaction, what your fee rate is and what fees might be to sell the business, and it it's good to hear an endorsement like that from a person like you. So thank you. I appreciate that.
Thanks, Chuck. Great questions. I have another question that's actually from myself here, Dave. So you talked about market multiples often being used in small business valuation. And sometimes we hear sort of a blanket sort of multiple tossed around, being that typically small businesses will trade at a multiple of 3. And I've heard business advisors kind of throw this, the 3-time multiple around loosely. But in your experience, because you mentioned this at one point in your presentation, that, check your industry for a multiple. Do you find that there is a large difference or range depending on the specific different industry, or would you tend to agree with sort of the canopy of the 3 times for small business?
Yeah, Liz, you're right. You can hear, the general range of multiples for a small business might be, depending who you talk to, 3 to 5. Well, first of all, I then ask, okay, well, what's that a multiple of? And then quite often it's a bit of a blank stare back from the party that pontificated that should be the multiple. So, and I say that a bit tongue in cheek, but there is truth to it. Back to my example where I was using 2 very different cash flow measurements, a seller's discretionary earnings, which when you add back the compensation for the owner, it's a much bigger number than a pure EBITDA number, let's say, which has the owner operator's compensation backed out of it. So, the multiple has to suit whatever you're multiplying it by. So I guess that's my first comment. The second one is, yes, different industries very much have different multiples, and then the multiples, you can continue to define them or refine them based on the quality of the business that you're working on, and a lot of other industry or company specific factors that go into it. So I don't think multiples can be one size fits all. I was on the call yesterday actually and talking to another valuator that had just seen his first 20 multiple on EBITDA on a privately held business. Now that's stupid high, and don't ever think that's the market, because it's totally not. Even a double-digit multiple is kind of the undiscovered country for most small businesses. So let's state that right off the hop. But I just say that because it can demonstrate multiples can be all over the map depending on the company, the time, the economy, everything like that. So then your next question is probably going to be, okay, that's nice, Dave, but how do I know what the multiple should be? Well, again, that's kind of the black box that you have to try to decipher or hire someone to help you with that. So, as a business valuator, that's kind of what I do for a living. Is a big part of it is determining what multiples are for different industries, economies, and points in time. But, definitely you don't have to hire a evaluator. You potentially can talk to business brokers that bankers that your accountant might have some thoughts on that. Industry research, your industry trade group may have some rules of thumb for that industry that they work in. And, you yourself at Village Wealth might have some thoughts on it as well. So, it does almost take a community to come up with the multiple. And so I don't know if I danced around that one is enough, but that's what I'm going to say.
No, that was great. It's always a fairly subjective topic conversation, and you know, a lot of the time it comes down to, you know, your level of confidence as a buyer or a seller in your own experience and due diligence. And, you know, you can go to one advisor and feel confident, or you can go to 5 advisors and feel far more confident. And, but definitely we always recommend at least bringing in some independent counsel for sure. So you mentioned that it would be a mistake to burn the bridge with the old owners. How do you recommend avoiding this when negotiating the best deal for a buyer?
Yeah, that one can be a bit of a delicate dance, because you're right. You, as a potential buyer, you want to get the best deal possible for yourself, and that usually means the lowest price. And one of my bullets, mistakes to be made, don't overpay. So how do you circle that square, right? As far as getting the lowest price, but also keeping in the good graces of the old owners. Well, to me, you know, part of it is, yes, you can have a spirited discussion and negotiation, but, you know, don't start things off with some a stink bid, if you will, you know, just a stupid low offer just to try to see if it'll stick or not. Sure, you can do that, and maybe there is a time and a place for it, but usually you don't get a very favorable reaction from the business owner. That's for sure. And you know, I also say to people that are selling or buying, you know, usually this isn't like it is in the movies. You know, you don't have this intrigue and many back and forth. And I usually, more often than not, I find the negotiation for price takes about 5 minutes. It's boom, 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 and in 5 minutes, you know, I say that a bit tongue in cheek, but it generally, you can land on the price fairly quickly. It's a lot of the other terms and conditions of the deal that can take time, and quite often can lead to more animosity than even the price does. And I think you do have to keep in mind that for the vendor, selling a business is very emotional. It's, you know, this is your baby. Maybe you've been nurturing it and for 5, 10, 20 years, whatever it might be. So it's very emotional. And at the same time, potentially the business owner is looking at their next phase of life, retirement, or their own mortality. And I don't want to get overly philosophical, but I guess needless to say, lots of emotions that are involved on that side. So I think as a buyer, you need to keep that in mind and try to not create further chaos in the discussion that may lead to frustrations and to get you, you know, on just to lead to bad places, because ultimately you do probably need those old owners to help transition the business. You want them to speak favorably to the old customers, suppliers, that type of thing, you know, take you around the new owner and talk warmly about you and how you're going to treat them well and all those things. And that's a tough ask if you've really beaten down the old owners in the negotiation and through the sale process. So that was kind of my comment as to why you want to keep it quite civil and you know, keep as friendly as you can with the old owner.
Yeah, absolutely. So we have a comment in the chat, and then we've got a couple questions in the chat too. So I'll just start. Adiola, I hope I said that right, adds that also can manage not burning the bridge through earnouts and other arrangements, keeping the owners on part-time basis or consulting capacity, or on a consulting capacity without overpaying. Lots of other structuring scenarios there. And I think we have some other sessions that we've covered on deal structuring. So unfortunately, we don't have time to go deeper into earnout structures, but we'll save that for another day, or I believe we have to, it's in the library there, but thank you for bringing that up, Adiola. One other question from the chat is, you know, right now there are businesses that are facing, you know, they didn't have the optimal time for the value acceleration period or exit planning or value enhancement in the years leading up to a sale. So for those businesses that are almost circumstantially you know, having a sale forced upon them, because maybe they were planning to sell this year anyway prior to COVID enhancing, you know, coming in. What are you seeing, David, as far as multiples right now for some of these businesses that haven't had that period of time to monitor, you know, or what are you seeing right now?
Yeah, and it's a very valid point, and definitely seen that with quite a few clients that we speak to, and you know, they were maybe business owners were ready to sell 5 years ago, let's say, and the Calgary economy wasn't so strong, so they decided to hunker down and continue to operate the business. And then COVID hit. Oh well, still not time to sell. And meanwhile, they've, you know, aged another 5 years, as we all have. So definitely there is a bit of a pent up supply issue, I think, that could be coming our way as far as supply of businesses for sale. But how do you address the potentially a value gap, if you will, with if the business has really been hit by COVID? And so it's a great comment, or a great question. I think you have to look at a couple of things. Probably you look at a pro forma with a run rate of what is this business capable of doing post-COVID, and hopefully there is some pre-COVID history that would help support that. So if you have that, good. But as far as what multiples are doing post-COVID, I'm a big believer that, you know, for small business especially, multiples don't change a whole lot year to year. Usually it's the cash flow number that is going to change, that you're multiplying to get to your value. So, you know, in good times, the cash flow number generally goes up, and if you put a 4 multiple on it, you'll get this, you know, this much value. And if it's a down year and cash flow is down a bit, put a 4 multiple on it, but you're still going to get hit with that. You know, your value is going to get hit that way. So that's just my comment. That's generally what I see. And again, that's more for small business. Maybe it's not for bigger businesses, publicly traded companies, new economy type businesses. But, you know, they might have their own story to tell, their own experience. But for small businesses, I generally don't see the multiples, you know, changing from a 3 to a 7 just based on a slight change in the economy.
Thanks, Dave. Sean has some questions that he'd like to pose. Sean, feel free to take yourself off mute, and I'll let you.
Good, thanks, Liz, and thanks, David. I appreciate this session. It's been great. Just a couple quick questions, circling back to the multiple consideration. When you've done it in your experience for small businesses, if there's minimal FF&E in the business, do you take that into account when you consider your multiple on a SDE or an EBITDA, or do you typically go the route of determining what you think the multiple will be, and then you plug in your value allocation of the FF&E and goodwill after that? So essentially, which one do you consider first?
Yeah, great comment, or great question. First of all, you know, as far as I start with the valuation first, and before I get into, okay, how am I going to allocate this value to the different asset categories? And sometimes if it's a small engineering firm, let's say, where there basically is little to no capital assets involved, you know, some tables and desks and computers, that type of thing, that's fine. And maybe that all the value is going to flow into the goodwill or the intangible bucket. So I don't have a problem with that. A buyer generally does like to see a little bit of hard assets involved in any transaction. So, you know, there might be some discussions there, but at the end of the day, you know, I think value is, in some ways, it's regardless of what the asset categories that back that value. Now, having said that, if generally, if there are no hard assets in a business, it would suggest that probably it's a slightly less multiple, just because there is no hard assets to back it up. And then the secondary factor is going to be financing for that purchase. And if there are no hard assets, a typical bank would probably not be totally favorable of 100% goodwill sale.
Yeah, perfect. Thank you. And I guess along the same lines would be in the same thing, an SDE or an EBITDA multiple scenario. In your experience, have you been challenged to that valuation from a standpoint of inventory or equipment, the values taken off the balance sheet and how much those should be discounted, or, so many cents on the dollar on that equipment or inventory?
Yeah, no, absolutely. If you have equipment that has potentially been fully or almost fully depreciated, it's going to be sitting on the balance sheet at a pretty low level. So I think you have to consider what the market value of that equipment is, and consider that in your discussions. So, that's maybe a first point. And, as far as, sorry, what was the second part of the question?
No, I think that covered it. It was just basically, again, the depreciation in both cases on the equipment, but then also from a standpoint of inventory, the value sitting on a balance sheet, and the discount that a buyer would certainly try to push on that valuation as well.
Yeah, and so yeah, thanks for twigging my memory there. The inventory issue, yes. Generally, it's going to be sitting on the balance sheet at, I would imagine, cost.
Mm-hmm.
I think that would be what GAAP would tell you there. So, I think, sure, there could be some type of a discount agreed to on that inventory, and they're going to age it as well, and they're not going to want to buy a lot of inventory with dust on it, for sure. But so that there's going to be an inventory count at close. Yes. And you'll probably value it at cost or something close to cost. So.
Yeah, we've even seen it go so far as people looking at they set an amount of inventory turns, and anything that's lower than a certain marker would be considered obsolete.
Yeah, good comment. Yes.
Yeah. Okay, thanks, David. I appreciate it.
You bet.
Thanks, Sean. Great questions. Well, we are at 12:29. There is one other question that was sent to me that is great. If you have to run, we understand that you'll drop off, but the question is really pertinent to what's going on right now, so I'm going to pose it. The question is, as far as businesses that have received the subsidies, the CEWS, the CERS, the TWS, are these, and grants, are they getting normalized back in?
So yeah, good timely question. I generally would not include those subsidies in any EBITDA calculation, and usually they're going to be adjusted out. But the codicil there is, okay, but on the flip side, you have to consider what was the expense profile, and what was there a change there. And by that, I mean, okay, if you've got a staff that is now 25% busy and 75% downtime, you agreed to take that on, or, weather through as a business owner, but you backfilled that with the subsidy. Okay, I can probably wrap my head around that one and say, okay, I can normalize for that. But if you're a business that was able to continue to keep quite busy and be quite productive during during COVID, and you were able to qualify and enjoy the Q subsidy, and it was almost a line item or a new service line for you, I don't think that should be added into EBITDA and a multiple placed on that. That's a real stretch, I think.
Mm-hmm. And I'd wager to guess, Dave, that right now, more specifically, is any buyer is going to do their own evaluation on any of the adjustments, maybe even more critically now than in previous years, right? So just having the seller be prepared for those tough questions and to be able to rationalize.
Yeah, agreed. And you're right. They are tough questions, and it's a real factor in deals that are happening right now, and lots of different opinions on how to adjust for it and incorporate it into the valuation process.
Yeah, again, more reason for both parties to have the right supports in place when they're entering negotiations. Absolutely. Well, thank you so much, Dave, for your time. Thanks for everyone who was joining us today.